Hey, good afternoon, everybody. Uneducated Economist here. Did you guys see the Dow today make that move, 800 points? Oh my gosh, that is huge. Compared to yesterday's 600-point loss, that is 1,400 points move inside of a single day. That is huge, guys. But that's something you're probably going to expect while you're in this down bear market. Volatility is really going to be quite extreme here during this time, and some of the biggest updates you're going to find are going to take place during the bear market. So yeah, this 800-point move upward, that is a tall tale sign. That is a tall tale sign of bear markets, where you'll have down days, down days, down days, and all of a sudden a big up day, and then down days, down days, down days, down days again. And the reason is because everybody sees these down days one right after the other, and they think, okay, that's it. And then once the market starts to move a little bit upward, they think, okay, cool, downtrend's over, back into the uptrend. But it's not. It's false hope. So don't fall for it, guys. We got a long ways to go in this market. Treasuries, right? Treasury yields are starting to get back into line a little bit compared to yesterday anyway. Today is January 4th. So yesterday we had two different inversions going on. There was one between the 1 month and the 3 month, and then there was another one between the 1 year and the 7 year. Well, that 1 month to the 3 month, it kind of corrected itself. It's back in line where it should be, being a little bit lower than the 3 month is, and the 1 year to 7 year, that's still inverted. So 1 year's pay higher interest than the 7 year does. It's, that's one of the inversions going on there, but still, it's pretty minute. Not the major inversion that we're looking for. Everybody's looking to see the 2 year and the 10 year inversion. So that's the sign that the recession is looming, or is, definitely in the works. Anyway, Fed fund rates. That's what I came out here to talk to you guys a little bit about. Somebody asked me to explain Fed fund rates. And what the Fed fund rate is the rate in which the big banks loan money on an overnight rate to each other. Okay, so if you're part of the Federal Reserve system and you're one of those major banks who has accounts with the Federal Reserve, then every night, if you have an excess on your balance sheet, you are forced to lend that to the banks who don't have excess on their balance sheets. So the guys who are under on their balance sheet borrow money from the guys who are over on their balance sheet till everybody balances out. Makes sense? And that rate, that Fed fund rate, that's the rate in which the banks loan that money to each other. So, and it's not actually the actual rate. The actual rate is called the Fed fund effective rate. And the Fed fund rate is the target rate in which the Fed is trying to get the banks to loan this money to each other. And the way they adjust the interest rate in order to meet that target rate, that Fed fund target rate, is to buy and sell assets that are on the bank's balance sheets. Okay, so these guys hold securities, much like like treasuries or whatever, and they buy and sell these things from the balance sheets of these banks in order to get them into line as far as the interest rates go on the federal fund rate. Anyway, I know that's a little complicated, but that's basically the gist of it. It's the interest rates that the big banks loan to each other on an overnight basis to balance out their balance sheets every night. Okay? So how is that different from the LIBOR? LIBOR is the London Interbank Offering Rate. I hope I got that right. And what those guys are, it's basically a bunch of these big banks from all over the globe. They kind of call the same people and they say, hey, this is what we're loaning our money for to the other banks. And so the LIBOR averages, they take all these numbers that are coming in from all these big banks to these guys, they find the average on that, and that becomes the LIBOR average. So again, it's not exactly the interest rate in which that all these banks are loaning money to each other at, but it is an average of these banks, once they call it in, it is an average of all these interest rates. So anyway, that's what the LIBOR average is. It's basically the interest rates that the big banks are loaning money to each other on a short-term basis, and the Fed fund rates is the interest rates in which the big banks loan money to each other on an overnight basis if you're involved within the Federal Reserve System. So anyway, I hope that helped. Keep your eyes on the treasuries. We're going to have a flattening yield curve real soon where it's going to go completely flat and then it's going to invert. Uneducated Economist. Talk to you guys later.